Okay, welcome back everyone. This is lesson 3.4, Financial Resources Management. In this section, we're going to be explaining how budgeting relates to financial planning and describe two kinds of financial reports prepared by businesses. One of the reasons why small businesses often fail is that they do not manage their finances properly. And if you remember back on when we discussed the business plan, that was a reason why a lot of small businesses didn't make it, is because they failed to make a business plan. If you remember, in the business plan was a section for preparing and planning your finances. So not budgeting your money properly is a reason why a lot of small businesses often fail. Businesses must wisely manage the money they take in and pay out to become profitable and to stay in business. Financial planning. A business budget is a detailed plan for meeting the financial needs of the business. Two main purposes is anticipating sources and amounts of income and predicting the types and amounts of expenses for a specific business activity or for the entire business. Okay, so types of budgets. So there's a startup budget, an operating budget, and a cash budget. So with the startup budget, that's usually the money used to get the business started for like your building, materials, supplies, licenses, money to pay your employees, advertising costs. That would be all in your startup budget. That's the money you need to get your budget up and running. Your operating budget is the day-to-day operation. It would cover your specific usually covers a specific time, usually about 3 months, 6 months, or up to a year. It's the money you need to operate from day to day. And then your cash budget, that is used for it's just an estimate of money reserved for any specific time where you may run low on cash, and so that way you don't have to go and borrow money to meet any expenses needed. So you should have a cash budget on hand and ready in case you would need it. So let's look at some financial records. A financial record shows the financial performance of a business. There is an income statement. That's a pretty common statement that's used in preparing financial records. It's the financial statement that shows revenues, expenses, and net income, or your profit, and or loss for a period of time. With the income statement, I think there is a copy of it on page 83 in your textbook. There is the formula. It's revenue minus your expenses equals net income or loss. So either you may have a profit or a loss. So if you take your revenue minus what you had in expenses, then it's going to tell you how you did within that time frame. Like I said, it's usually either a 6 month up to a year is usually how it's reported. And then there's also a balance sheet at the bottom of that page. A balance sheet is the financial statement that lists a business assets, liabilities, and owner's equity. So here's the formula on how to calculate that. So it would be your assets equal your liabilities plus your owner's equity. So maintaining financial records, you would need to collect information, prepare financial records, and maintain financial records. Normally, when doing the financial records, it's usually easily done in a spreadsheet, normally done in Excel. We don't really go into detail into this class, but it can be calculated up into an Excel format, and that way it can be prepared, and a lot of companies use that form to create their financial statements each year. Okay, so that is chapter 3. That concludes all 4 sections of the chapter. Again, go back, make sure you read each section, complete your study guide, and use it to prepare for your test at the end of the week. Okay.